Property and Propenomix people, and hello Propenomix people, and welcome to another Suppplement Live. And this week's is called 3 Years Post Lettuce, and you'll soon find out why. So if you've watched before, you'll know I like to start with a quote. And this week's quote is, "I don't believe in guardrails," and that was from Mary Elizabeth Truss, who I deemed to be called the Lady Jane Grey of Prime Ministers. And this week's quote goes straight to the deep dive and tells you just how seriously the former PM learned any lessons from her fleeting tenure. So, Trumpwatch to kick us off. Will this section ever be empty? Not for a few years, it seems. 2025, when it's reviewed, and it won't be long until those all start, I'm sure will be remembered as the year of the tariff. New tariffs this last week, 100% on imported drugs, still be about 500% cheaper than the US branded stuff, I'm sure, as long as you accept Trump math, as they call it, on the other side of the pond. 25% on heavy trucks, 50% on some furniture and fixtures. So we're getting towards the end of the barrel, it feels like, although as I've already spoken of, depending on the legal action going on around the tariffs, there could just be a complete round two in 2026. Because one thing we know is Trump's not going to stop, ultimately, until he gets what he wants, regardless of the law, realistically. So, results included an absolute surge in US onshore biopharma stock, of course. US stocks were up, Asian stocks were down. Another great Trump victory, maybe. But the counter, the continued erosion of the US safe haven status. That's an interesting argument. And let's pause on it for a moment, because we tend to think about investment in quite short cycles, not in property. We think very particularly long-term, usually, in property, unless we're trading it, of course. But the amount of news that's pumped out around stock prices, crypto, gold, etc., there's loads of it. Day trading is the cool thing, right? Robin Hood and all the rest of it, Wall Street bets and the likes. So there's also long cycles. Ray Dalio talks quite a lot about these cycles of dominance. The global reserve currency period for the US, which is not yet 100 years old, actually, but often more called into question these days, perhaps than it ever has been before. But Trump would certainly not be solely responsible for ending it, if indeed it did end, but there's most definitely at least a watching brief being adopted on the US by a percentage of participants. John Authors, who writes a brilliant newsletter for Bloomberg, it's called Points of Return, his free newsletter, you can go to the Bloomberg site and sign up for that. He said in the past fortnight or so that US stocks are overvalued and people are buying more. Deliberately tongue-in-cheek, of course. What do we really know? Because ultimately the effects are speculation-driven. Well, investors don't like uncertainty, and another year of tariffs would mean another year of relative uncertainty and perhaps an even weaker dollar. And then once again, the name Stephen Mirren, that's Trump's favoured stopgap appointee on the Federal Reserve Board, comes up in this segment too. He talked about a Fed funds rate down at 2.5%. So somewhere between the Donald's 1 to 1.25% that he seems to have thrown out there several times. I'm not sure it would be that scientific given his maths on the drug prices and all the rest of it. And what's the current Fed funds rate? 4 to 4.25%. So a drastically different position to his colleagues on the board, fair to say. He also, in a quote I suspect will be revisited again next year, said that it was interesting when the Fed didn't have a formal inflation target. So we're going back about 15 plus years there. And whilst he thinks inflation should be down to 2% for a sustained period of time before this is revisited, he suggested that the old remit, which was low and stable prices, would be fine rather than a specific number. Now, sometimes what's lost in these situations is the context, right? Fed funds rate, the range is actually 1 to 3% that's acceptable as long as the pathway is to 2% in the medium term. So it's not really a 2% target. It's more of a 3% ceiling. Now, dropping that 3% ceiling, I think, would surely impact the attitude of the bond investors. And they want handsome money, return on their money, for lending to an overburdened, overspending United States. He also confirmed that Trump had not pushed him to follow any specific policy. He confirmed he was operating independently and says that he does all his own analysis on how economics and the economy works independently. Yeah, in quote marks, I'd say. I'm going to be sceptical there, I'm afraid. He's a believer that fewer migrants means lower inflation, preferring the side of the argument that says freeing up housing and lowering rental costs by reducing demand The other side of the argument is goods and services get more expensive because the labour to produce them is more expensive. Time will tell, of course, and it's difficult to do that analysis at a granular level because there's other things going on all the time that impact inflation anywhere, but it feels like a political position rather than a real economic arm wrestle, to be honest with you. So Miran's got this temporary term at the moment, and he's got about a 15% chance, according to Polymarket, which is the Bible these days for political related betting around the world, of being the next Fed governor. So by no means a shoo-in, 6-1 odds or something like that. There are 3 names ahead of him in the betting. You'd think he'd be taking a longer term role at some point, though, at the Fed. He's most definitely a popular choice at the White House, regardless of the party line, but perhaps he's just the first trailblazer rather than the answer to what Trump and Bessent see as the problems. Former Trump economic advisor noted that the US job market appears to be weakening, which is impossible to disagree with, really, although Gary Cohn did row back and say it might be temporary. The US core PCE index, which is their preferred measure of inflation, came in on expectations at 2.7 and their core was 2.9. So we don't feel too near to that sustained period at target that Miran referred to. Consumer expenditure was up 0.6 in August, so that suggested resilience amongst the US consumer, which has been a concern. Now, the regular debt ceiling meeting is coming up, the biggest pomp and circumstance nonsense meeting in American politics, quite frankly, where they pretend they've got this debt limit and they're really carefully looking after it, and then every single time they raise the ceiling. Now, sometimes there's horse trading, some negotiation, it spooks the markets, and it includes mass federal firings of federal employees in agencies whose functions haven't got clear statutory backing. That's what's been going on. Doge-style stuff, basically. There's also been a freeze on $5 billion of foreign aid, which has been to the Supreme Court and has been upheld as the executive order or the executive authority powers continue to be challenged. And then the heavy hand this week wanted to swat away Lisa Monaco at Microsoft, who had coordinated investigations into Trump's 2020 election challenges. File under overreach or perhaps just holding a grudge. The argument, I think, here, rather than the conventional left wing of the press argument, that this is complete despotism, is that Trump is just much more open about the sorts of things go on all sides. And he just doesn't care about the optics of them, right? He definitely goes further than some, but not as far as a Putin or an Orban or whatever. Does he go too far? Well, you can only watch and speculate, really. But we all know the deep state, or whatever you want to call it, or certainly the invisible hand at the market level, moves in mysterious ways. It's also often used as an excuse for things when people are frankly incompetent. But we'll talk a bit more about that later on. The former director of the FBI, James Comey, from Trump's first term, was back in the news, which I'd describe as a week of vengeance and vendettas, really. The message is clear: get in the way of Trump 2.0, and in future you'll be in court and your life will be ruined. It's a brutal old game, and watch out for the markets coming as the shutdown approaches. So back to our comparative safety of the real-time UK property market. Chris Watkin has delivered, as always, week 37 in the book. Listings printed 35.9k, a lumpy week. My 10% more stock than in a normal market ready reckoner is still working on the back of circa 2 years of overperformance in listings compared to historical averages. But when you look at what actually happens, so what actually gets listed, a tiny bit more than 50% of it gets sold. If you imagine adding 10% onto that, it moves from 50% getting sold to about 45% of a normal market transacting. Now, luckily, transactions have picked up a bit, so it hasn't quite worked out as badly as all of that. But it's not helpful if you're trying to sell property. And it is helpful if you're trying to buy it, which is good for at least half the people listening, I'm sure. So this year so far, we've had nearly 2 years of overperformance in listings, and there's been 1.34 million homes listed in the first 9 months of 2025 or so. We haven't quite got the figures yet for October, so that's not even the first 9 months. That's sort of into September till about the 22nd or whatever. We're 10.6% ahead of the 9-year average. That includes 2020, so it does pollute the figures a little bit. But we're really inching back towards the 2024 listing numbers now, which before this year was the biggest listing year for 10 years. We were 6 to 7% above them at various points in the year, but we're still listing more than we're selling, as always, so it's all about the withdrawals, realistically. We're now only 2.8% ahead of the 2024 listings year to date, but we're still 10% plus ahead of the 2017 to 19 average. So price reductions in week 37, 26,200. August completed number was only 11.1% for reductions. July's was 14.1, June's was 14, May's was 13.4, last year was 12.1, the 5-year average is 10.7. The 2025 average is 13.1. So what we're seeing is more stock, more reductions in percentage terms and of course in absolute terms because there's more stock. 22% more reductions than the 5-year average. I'm using the ready reckon 25% more reduced properties than a normal market, right? It's probably an underestimate because that extra bit of stock out there probably adds 10% onto that, and it's more like at certain points it's been nearly 40% more reduced stock than the typical average. At the moment, they'd be around the 25 mark. We still had 90,000 plus price reductions in the past month, so please don't spend any time telling me you can't get any deals out there. There's plenty of stuff there. You don't see 13% or more of stock being reduced in a strong market by any stretch. Of course, holidays slowed things down a little bit, but sideways pricing continues. And I don't read too much into August, so we'll have September's numbers relatively soon within the next couple of weeks, and we'll be talking about those. 25,300 homes sold subject to contract, healthy enough. The annual average 26,200. Sold subjects are up 5.9 year on year and 13.5 on 2017 to 19, the pre-pandemic market. Still nearly keeping pace with 2022 as we near the day of the lettuce in historical context, because these figures run a week behind, remember. And sold subjects up nearly 6%, but listings up less than 3%, 2.8. Remember, this feels like more intention to transact than 12 months ago, or it feels like a bit more of a functional year than 2024. Although stock numbers have continued to rise, as I've said. And we went into September with 736,333 homes on the market, which was 25,000 down on August's number. I've been waiting for this month where there'd be a drop because it's been a climb, but the drops happened. September 1st number is not usually a drop either, and it's very rare that it would drop that much. But don't read too much into August. 1 month doesn't establish a trend. You really need 2 or 3, realistically. It'll take we need some more sales agreed for that trend to happen. And a week like this sees 25,300 gross sales, 35,900 gross listings. So unless there's more than 12,600 properties withdrawn, which is a lot for 1 week, there's normally more like 6,000, 7,000 withdrawn in a week. It's not going down just yet. But it's all about clear outs that also happen at certain points of the year, normally in an August and a December to an extent. So we've probably had the last clear out we're getting until December. For a bit of context, the market got stickier before the pandemic. That number was 660,000. The seller's market is likely under 600,000. At the end of August 24, 710,000 were on the market. September's figure will be interesting as we don't watch the number of properties withdrawn from the market week on week. Chris also looks at the per square foot on sold subject to contracts. It's got a very strong correlation with prices that hit the land reg in 5 months' time. This time around, August was £338.78, and I'll be per foot of sold subjects. We'll be watching that closely when we get September's number. Only 1.41% up on the year before, but 14.25 up on August 2020. So only 14.25 up in 5 years. Pretty incredible. June's number is 2.2% down on June's number of £346.45 a foot, and 1.75% down on July's number. Now, if that was out there in the headlines, people would lose their mind, because they lose their mind at a 0.5% drop in a month over a Halifax index or whatever. So 1.75 down on July is significant, but it's August. And it's a month where deals are always done because there's fewer buyers around. So I wouldn't be reading too much into it on that basis. But that 14.25 August to August over 5 years, when you think about what inflation's done in that time period, when you think about what wage increases have done in that time period, property's a lot cheaper in August this year than it was. Now, that's not a perfect comparison either, because what we don't know is if the same sort of houses were selling in August 2020 as to August 2025. What happened in August 2020? Well, lockdowns had been lifted. People suddenly needed extra bedrooms. They were moving out of cities towards suburbs or areas where they could commute to the office less, 1-2 days a week, or go fully remote or whatever. So be careful. It's only 1 month to 1 month comparison, but we'll keep an eye on these numbers as time goes on. Fall through stayed a little bit above the long-term average of 24.2, so they printed 25%. Carries on that pattern of not very much volatility for many weeks now. There's been a little bit more noise than usual, but there's a bit of bank holiday catch-up that goes on as well. So we have to consider that. Now, we're not quite at 2022 levels in terms of net sales yet, but we're very close. 5.1 up on last year, 10% higher than 2017 to 19. But let's see where we get by the end of the year. I think it's going to be a close run thing on transaction volume compared to 2022 in a much less volatile year. And in fact, I'm confident 2025's volume will beat 2022's, in spite of the fact that 2022 started as such a white-hot market. Then Chris also offered up one really extra interesting graph this week, average rental price versus number of available properties. Now, I'm not that interested in the former. It'd be best adjusted for inflation or wages in my view, but I'm much more interested in the latter. So the numbers that give us some context and keep things straight, if you like. Pre-pandemic, there are about 350,000 rental properties brought to market in an average month, right? So that's about 6.3% if you work on 5.5 million, which was roughly the accepted number before the pandemic of how much PRS stock there was in the UK. In August 2025, that number was 299k, similar to 2024's number, but much better than 2023's number of 243k. So at a base level, you suggest the normal market, the old days was 350,000 available. The new normal looks like about 300,000 available, down 1/7 or 14%. And constricted with rocketing rents looks like 250,000 or thereabouts, which was 2023's market. So you can see the vast improvement there's been compared to 2023, but also the contraction that exists from before the pandemic. So anyone saying that PRS hasn't shrunk in size over the past few years is not looking at figures like this, in my view. We have to wait for the English Housing Survey to confirm this, because this is the one thing that the politicians listen to. It's quite slow. It comes out in December usually, and that's reporting on the year ending March 2025. But that year, April 24 to March 25, the reports are going to be quite simple. Rents have rocketed. I expect the PRS might have ticked down to 18% of the stock instead of 19%. But no one's going to get out their seat for 1% in stock, because they're not looking at the granular level about what this means about available rentals. Anyway, I always give Chris a weekly shout out because he's much more prolific than only this epic tome that he drops on a weekly basis. His content's great. Please drop him a like, a subscribe, and all the rest of it at Christopher Watkin on his YouTube channel. The article goes on the Property Industry Eye website. And if you want any support in your business in growing it, or to be a more effective communicator, be more in touch with your local market, give him a shout. Okay, on the macro side of things, macro muddle is the word of the week, because so many metrics keep pointing in relatively different directions, which ultimately takes us to sideways. So first up, we had the Flash PMI numbers. And Flash is the word, as a couple of very positive months we've had recently look exactly like a flash in the pan now, unfortunately. The rest of this week's macro was all bond and rate focused, pretty typical in a week after a Bank of England meeting. So I had the chance to look back and look at Rightmove and Zoopla asking prices and rents, and also an ONS report on housing purchase affordability, which is a report they only publish once a year. And then bringing up the rear, we've got the gilts and swaps. So the Flash PMIs, private sector output expands at slowest pace since May. So we basically had a flash quarter, if you like. That's a shame, but remember, we don't judge anything by 1 month, so we must stay positive. And the composite index is still above 50. The flash print was 51. Manufacturing printed 46.2, a 5-month low. The woes continue. Services 51.9 is only a 2-month low, and as always, that's the driver. We don't see construction in the flash numbers. And the trend recently is that the final prints have actually exceeded the flash numbers. So let's hope for that again for September when we get them in early October. What's the makeup of these numbers? Well, weakening growth, slumping overseas trade, worsening business confidence, and more steep job losses. Ouch. Very negative sounding for a positive report. But of course, we're looking at a drop from a composite print of 53.5 last month. So that's a big drop, 2.5 points in a month. Good news, won't take long. Price pressures moderated. One of the smallest increases in prices charged for goods and services since the pandemic. So still going up, but going up more slowly. Call from the chief business economist at S&P is back to cutting rates due to a faltering economy and 50,000 job losses in 3 months. And it's a solid argument. That conveniently leaves out the backdrop of the expected 4% CPI print for September, but there we go. Now, what will also bring up the rear on such a bearish report as well, because of the time of year? Budget worries mean worsening business expectations, which I actually don't think is that realistic. I mean, all the chatter has been personal tax, not business tax, property focused, as you know. The conclusion overall is just being brought about by last year's action, and the business sector does not yet trust Rachel Reeves, ultimately, is the bottom line. I don't blame businesses for being bearish. Not getting hammered again is not really a great way of approaching a budget or any planning for 2026 or whatever. Nothing much good's going to happen in the coming months if we're going to get paralysed by the budget again, which of course is now November 26th. So last year's September is this year's October, if you like, and September was when volume really started to pick up in my group of businesses as people started disposing of assets left, right and centre. And that's because last year's budget was October the 29th, this year's is November the 26th. So we knew it was coming at some point. Let's just focus on the 51.9 print for services because that drives the economy, and the 51 print for the composite, which is the big one. So it's very small, slow growth is what we'd expect. What about the Rightmove asking price index for September? Up 0.4 on the month, but then September always ticks up just as August always ticks down. It was the first rise since May in the asking price index for Rightmove, and asking prices are still down 0.1 on the year. So that amount of stock is still weighing on pricing quite clearly. Sales agreed are up 4% according to Rightmove's data year on year. So that's positive. The next bit won't necessarily surprise, and we'll put context into play for everybody who wants a bit of context and everybody I'll speak to in the cheaper areas of the country. The strap line, the annual price fall is driven by the south, which could be hit harder by rumoured property taxes. What they're referring to there is this idea of lumping stamp onto houses that cost more than 500 grand. I don't think it's happening. It seems ridiculously unfair, but who knows? They're going to do something, aren't they? Whether it's changing IHT thresholds, doing stuff with VAT, doing stuff with capital gains, probably unlikely, to be honest. I think they've probably pushed it as far as they can. I wonder if the Treasury cares or listens to how much damage this speculation does over the summer, but I doubt they do. They seem to feel a need to fill column inches with something that perhaps makes them look fiscally responsible to the OBR or to the international bond markets, but they don't look fiscally responsible when they can't control spending. All they're trying to do is work on revenue, and that revenue ultimately comes from us as the taxpayer, or more accurately, about 50% of us, because about 50% contribute positively to the tax system, and around 50% are net removers from the system. Now, before anybody goes crazy with that stat, please bear in mind that includes a lot of pensioners, ultimately, because they're obviously taking out 12 grand a year and they're not paying 12 grand a year in tax anymore because their incomes are not as high as they once were. So that explains about 13% of the population. So still 37% non-pensioners taking out net, 13% pensioners, of course, who don't all take out, because probably 1%, 2% of those still pay more tax than they receive in state pension because they've got solid incomes, final salary pensions, the likes of that, presumably the top sort of 5 to 10%, I'd imagine, and then 50% of the rest of us net paying in to the system. So that's adults, by the way, as well, just to be clear. So we're not including under 18s in that calculation. So they'd also do an interesting breakdown in Rightmove of the glut of stock. 9% more homes for sale in the south compared to 1 year ago, 2% elsewhere. And they take five days longer on average to go sold subject to contract. The 4% increase in sales is split 3% in the south, 5% in the rest of Great Britain. Rightmove admit they see nothing in the data with respect to property taxes, but are speculating on what will happen until the end of November in their headline. They're bullish for buyers about improved affordability, sensible pricing, and a high choice of property, all of which makes sense. The breakdown always interests me at Rightmove when they break back to categories. First-time buyer asking prices are down 0.2% year on year. Second steppers are up 0.6%, and top of the ladder are down 0.2% year on year. It's a fair difference when you add it up. The middle of the market seems to be doing okay, which is very similar to reports I hear on the ground from agents and those in the know. The average September bump in the Rightmove asking price index is 0.6, so the 0.4 we had is a little bit below that. which again is more symptomatic of this sideways market I keep talking about. The Southwest has prices down 1.3% year on year, asking prices that is, compared to the Northwest where they're up 3.2. So that tells you the regional variability. There's about a 5% gap between those two numbers. And Rightmove, as they do on a monthly basis, highlights the drop in the 2-year mortgage rate, which is down about 0.5% since the first base rate cut in August 2024. They don't put in the context that 75% or more of mortgages were written as 5-year when that inverted yield curve was with us, when the 2-year money was a lot more expensive than the 5-year money. That ironed itself out in the early part of this year, and so far has done that without recession or incident, primarily because where the base rate was highly restrictive, and the risk management piece from the Bank of England had probably gone too far, if I'm honest. But there we go. There'll be more popularity for the 2-year mortgage again now, I'm sure, as memories of the lettuce fade. I wouldn't be doing too much 2-year fixing before the next election personally, but there's a lot of time to talk about that just yet. The Rightmove graphs show that effectively there's been no change in average asking prices compared to the top of the market in the first 3 quarters of 2022. 3 years of sideways on their data, which pretty much plays out with the prices actually achieved. Nationwide, there are parts of the North and the Midlands that are still seeing 10% plus price rises in the past 3 years, and also in Scotland and Wales too. Northern Ireland is well ahead of that. Scottish properties are taking 33 days to find a buyer, compared to double that south of the border. So just something to know. That sounds like a pretty hot market to me in Scotland, whereas hotter regions south of the border are still taking 60-ish days, and the colder regions are taking 70-ish days. And in London, Westminster has the dubious honour of the largest asking price drops year on year, down 8.8%. Islington asking prices top the table at the other end, up 2.6% year on year. So what about the UK rental market index? Well, Home Track or Zoopla have 2.4% as the new let inflation figure. Rental supply up 19%, which is a bit like some of the figures we talked about with Chris. That's about congruent, 300k instead of 250k. So that's about 20%. So those numbers add up. Rental demand down 24%. A huge shift in the market. Softest rental market conditions for 5 years. Why? Well, lower migration and improved first-time buyer affordability. Growth in supplies across all areas, but less so in London, which may not surprise anybody. That 2.4% is that lowest figure since 2020 in terms of rental inflation. This is on new lets. Remember, Zoopla and Home Track always talk about new lets, not existing. So if you're aware of the figures we talk about on a monthly basis from the ONS, they always talk about existing rents, which the last print was still nearly 6% up year on year, but it's tapering right back from the 8s and the 9% that it was at earlier on this year. And that was very much lagging inflation from 21, 22, 23. So the exec director of research at Zoopla, Richard Donnell, calls this the normalisation of the rental market after an imbalance between supply and demand. And as usual from Richard, this looks both intelligent and reasonable. So the context, well, 16 days on average to find a tenant versus 12 days in 2023 at that low point I talked about earlier, with only 243k rental properties going on the market month on month. And it was 20 days pre-pandemic. So it's a shift back towards the pre-pandemic normality and the cooling after the white-hot rental market of 2023. The gross yields reported was 6% in the UK, up to 7.5% in the North East and Scotland. Buy-to-let loan volume is up 60% year on year, or it was. They used the UK finance data from Q1 to make that claim. So we're going back a fair few months now, but it's fairly obvious that things have improved, but they came back from a very low level in points of 2023, 2024. And when we go regional, homes for rent are up 36% in the Southwest and 31% in the East Midlands, whereas rental supply in London is only up 6% on a year ago. So it's the demand dropping in London that's having more impact on that market. The average deposit to buy instead of renting a property in London is £187,000, Zoopla claims. So you can see why many people rent there, of course. 31% of all the homes for sale in London are landlord owned at the moment. Now they would define that by it's been on Rightmove for rent at some point in the past 4 years is their normal definition, possibly 5 years. So that's a huge percentage, and you see, surely anybody can see that the rental stock must surely be going down, although it's only up 6% on a year ago. So it has still moved forward somehow. But let's see what happens and whether those, now they're not all guaranteed to sell, of course, or the landlords might be willing to drop the price they need to in order to sell stuff, right? So first-time buyer mortgages are also up 30%, comparing the first half of 24 to the first half of 2025. First-time buyers are doing more and more, which is impacting rental demand, of course. Average UK rent is up £4,100 a year when you look over a 5-year period, which is huge. So the incentive to buy is even higher. Bristol rents are down 0.5%. Leeds rents are down 0.6%, both of which might be a surprise, but both cities are comparatively expensive compared to their surrounding areas. Zoopla's number for rent inflation for 2025 is 3%. Belfast rents are up 9.1%, but it's still the second cheapest top 20 UK city behind Aberdeen. But then wages are lower as well, generally speaking, in Northern Ireland. The best single word takeaway from that report is normalisation, I think. And this comparative claim that wage growth is outstripping new rent growth is helpful for prospective tenants, of course. The disposal that's going on is also playing into the hands of first-time buyers, and the vast majority of people will be very happy about that. Usually the exiting landlords are pretty happy about it. And I always prefer to sell to a first-time buyer, one, because it gives you a nice warm, buzzy feeling inside, and from a commercial perspective, they're much more motivated than selling to a cash buyer who might be flaky, renegotiate, pull out, mess around, all the rest of it. So first-time buyers, usually, almost certainly by definition, are not in a chain either. So it actually is a nice, clean, neat transaction. So when we sell properties, which we do on a regular basis, we're always hoping we can sell to first-time buyers, and that's the sort of stock that we've normally got. How about house purchase affordability then? Well, this report goes back to financial year ending 2024, 5th of April, although that's only just been released. I mean, 18 months is ridiculous, really. But it looks at a few nerdy stats, such as the median house price to disposable income affordability ratios. So I have just a little thing to say about these. There's a bit of an awkward truth that the average household that rents privately earns about 35 grand a year. The average first-time buyer household earns 60 grand a year. And that ultimately, that gap is what puts a difference between the pricing on, so looking at what the average household earns only has limited usage, because there's clearly a huge gap between households that can afford to buy and households that can afford to rent. But the ONS are not worried about all of that. So what are those ratios? 7.9 times in England, 5.4 in Wales, 5.3 in Scotland, and 4.6 in Northern Ireland. So in context, what does that mean? 290k for the median home in England. Again, I would knock that, because you're not going to buy the median home as a first-time buyer. You're going to buy something up to the 20th percentile or something like that, because it's your first one. Then hopefully maybe your second one is nearer the median, and hopefully then your last one is above the median as you grow and get older. But again, who am I to tell the ONS how to do proper analysis? So that average household income in England looks very similar to the other nations, about 37k. The other nations, it's about 35k. So you see the much higher pricing in England definitely gets in the way. And affordability increased compared to 2023, which I think we knew, but according to the ONS, homes have generally been unaffordable since 2006. I'm not sure how they know how silly that makes them sound, because they are not measuring the right thing if homes have supposedly been generally unaffordable for 18 years. But their favoured metric, a median priced home, was affordable in Wales and England for the top 40% of income earning households, compared to only 10% in England. I guess in Wales and Scotland, you'd like that to be 50%, then someone nearly at the median could afford the average house. But it just sounds like nonsense, doesn't it? If only 10% of households could afford a median priced home, prices would have to crash. The metrics they're measuring things on just must be wrong. They've also modelled, they have a new modelled local authority data set. So 29 out of 317 England and Wales local authority areas have homes affordable to those who work there, 9.1%, which is the highest number since 2004. Now, that's in line with my analysis on affordability and pricing as it goes. Completely different methodology, but the same conclusion, but well below the start of the series in 1999, which for whatever reason they regard as the good old days. So it's all a bit abstract when you're making claims like only 10% can afford an average house if you're measuring average by the median. In reality, you buy cheaper, like I say. But if lenders or the regulator took a view on affordability similar to the ONS, there'd also be a huge crash in mortgage lending. of course. The frankly arbitrary affordability threshold is 5 times household incomes. So that's not in taking into account the deposit, of course. Average first-time deposit is 20%. You see how close everywhere is. If you take that first-time buyer deposit out, you're reducing the house prices by 20% because that's been paid for by a deposit. I have no idea why the ONS think this is a good piece of analysis. It's some of the worst stuff I've seen them do, to be honest. But the affordability threshold in England is down from 8.77 in financial year ending 2021, although incomes were trimmed by COVID probably, or 8.68 in financial year ending, so that's end of March 2023, which would have been a year of two halves really, a white hot market at the start and then the lettuce, who's getting a lot of action today, isn't she, on this one. So stability in England post-crash looked like about 7.5 times on this calculation, which I would project is probably roughly where we're at for financial year ending 2025, although we won't find out for another 12 months when this report comes out. But if you look it up, if you look at the supplement on my LinkedIn, you'll see there's a great interactive regionalised graph, well worth playing with for the stats nerds out there. I loved it. There's a link in my LinkedIn version of the supplement if you want to go and take a look at it, or on the Property and Macroeconomic website. Thanks to James for hosting it on there. For those who don't want to click the link, it tells us about how the affordability clusters around the regional average, and for me, it shows just how affordable or not some areas are, and thus where capital growth and rent growth might struggle a little bit more in the future. In no surprise at all, 17 least affordable local authorities were in London, and the top 10 most affordable were 4 in the northwest, 4 in Wales, 1 in the northeast and 1 in Yorkshire. So remember, this is about localised incomes as well as house prices, which is why incomes are fairly strong in the northwest and house prices are still comparatively low, but that's why they've improved so much over time. The clusters of more affordable local authorities were South Wales, West Lancashire and Newcastle/Hartlepool. And again, you can go on the link and look at the interactive map to search by local authority if you want to. So it's an interesting report because you can compare years to other years. So I like to look at what it looked like in 2007, 2008, for example, on the heat map. And you can really see on the heat map how warm 2022-23 really looked. And so you might support the tongue-in-cheek argument I've made before that the lettuce actually did us a bit of a favour because she popped the small balloon rather than waiting for the really big bubble. Not what she meant to do, of course, but never mind. And you certainly wouldn't go about it the way she did. So what about the gilts and swaps? It was another ropey week. Weak demand for bond auctions didn't help on Thursday, and that manifested itself into a jump in yields mid-morning. The bond vigilantes are looking for bond auctions that don't go very well because they're all worrying there won't be enough demand, particularly in the US, but this also translates to the UK because we still need people buying. And ultimately, if yields come down, there's going to be less buying going on as well. So we do need to bear that in mind. The US data was deemed positive this week. US GDP revisions were stronger than expected, and so the bond vigilantes were back out. We opened at 4.13 on the 5-year, and we ended the week at 4.186. But the 30s, by comparison, only went up 1 basis point on the week. So the yield curve actually got a little shallower. Thursday's 5-year close at 4.178 compared to a swap rate of 3.81, 37 basis point discount, which is the pattern we've been seeing for the past year. Lenders won't be worried because volatility is much lower, but the next time they provide a new product, they will be at higher rates than the last lot. So if you're sitting waiting, the products that are out there at the moment are the 5.4s and the 5.5s. I would get on with taking a price on those very, very quickly. But my personal opinion is normally just get on with it unless something strange is going on. June 23, when the 5-year gilt was 5%, I was like, this is too high. This is going to come down. And sure enough, it did fairly quickly moderate. So into the deep once more. I'm commemorating the 3-year anniversary of the Kamikaze budget and also looking at a couple of reports, which I'm going to start with. First, Shelter's More Than Bricks, which was released this week, an interim report on the human and economic impact of social homes in a partnership with IKEA. So where are the facts on social housing in general? If we look at the private case, social homes yield about 1 to 1.25% over time on credible calculations that I've seen done that I've had shared with me. You very rarely hear the yield mentioned, and indeed most will argue that you shouldn't be thinking about money in this case. But ultimately, resources are scarce, and that's why economics exists, right? So get pragmatic in at least attempting to gauge the yield. A couple of things you might notice there though. When money was nearly free of debt, so May 2020, let's say, so 0% debt, the 50-year bond yields were 0.5%. So you could have actually borrowed money at that level for social housing, and it would have actually stacked up from a commercial perspective. But still, any other investment class from a pure returns perspective would have beaten it. And then B, which follows on, is that effectively it's impossible to expect anyone private to build social homes when the yields are 1 to 1.25%, unless it's literally philanthropic, isn't it, realistically? Now, there are altruistic moves. I mean, IKEA are involved in sponsoring this project, right? They understand the powerful effect that good social housing has in a functioning housing market. And Scandinavia is famous for having great social housing, and a state that is a lot larger in percentage terms as well, of course. The UK remains pulled between the US model of a smaller state and the European model of a much larger state. And there's probably a floating 55% in favour of one or the other model at any one point in time. Probably 52-48, some might say. But it's not just that. Social homes provide far more societal value than their investment yield. There are many more benefits which you can and ultimately only capture if you are the Treasury, right? And that's the problem. And you need to ascribe value to these things to understand how to allocate resources. Yeah. And of course, the other people that benefit is the consumers of the social homes, those who get one, more likely to have a great EPC, cheaper rent, so cheaper running costs as well. What's not to like, right? So the Treasury are the only ones who can capture the value of having people having higher disposable incomes, more stability, and the ability to invest in themselves, and a greater chance of becoming contributors to the public purse, going back to what I said earlier on, versus net withdrawers. There are all sorts of studies that attempt to measure this, but let's stick to what we know. The £39 billion contribution announced over 10 years by the Treasury, with some rules to keep it fairly level year to year, is an improvement on where we were. The Green Book numbers, this is the official numbers on how to appraise a public sector spending, tell us there's between £1.50 and £2.20 of PV, present value, net present value, in upfront subsidy of social homes. I'm not going to try and take that assumption apart. That would be the next step if there was genuine interest from the government in making the sort of investment that's really needed, which probably looks more like 20 billion a year than 4 billion a year, according to commentators who tried to put a number on this in the past. Now, the recent Shelter numbers, who proposed the 90,000 social homes built per year, are suggesting a payback in 11 years and a net fiscal surplus of around 12 billion over 30 years. That's comprised of reduced housing benefit, tax receipts going upwards because of stable employment, and lower public service costs. Savings go upwards when you look at higher need cohorts and supported housing, which is why providers often measure their impact by how much have they saved the NHS this year, for example. Then there are wider macro impacts, such as increased GDP thanks to the build, lifting PAYE, VAT and corporation tax, and reducing spending on homelessness and temporary accommodation. But there's a massive gap between assumptions used for social homes, for example, £75,000 subsidy per unit, and the private sector's idea of what it takes to subsidise a social home, which is more like £225,000 a unit. And this is why so much Section 106 is not building social homes. Affordable or other types of tenure or solution are much less loss-making, or even might make a profit, and subsidies just do not bridge that gap. So when you look at the major variables, you need to disallow right to buy to not affect the numbers too badly. You need to target lower land cost areas, and you need to target high need groups as well. Not great news for social homes in Bristol or London, you'd imagine. It's not unusual for the government to be pecunious and the private sector to claim far more money is needed. We know that much. That's what always happens. But the private sector has a limited amount of skin in the game here. They're not going to be building these themselves with their own money. They would only be delivering, ultimately. And currently, providers or housing associations cannot deliver many Section 106 sites or indeed buy them. So we currently have something like 10 to 17,000 Section 106 affordable homes. So forget social there. These are affordable, undeliverable in England and Wales, or stuck. It might be the expedient way of saying it. Then there are those that are built but cannot be taken on by RPs. Put another way, there were nearly 3 billion in unspent Section 106 contributions across local authorities when a whole slew of freedom of information requests were put in a couple of years back. So the best description strategically of the current state of play is a systemic bottleneck. So There's the context as I understand it. It offers some more viewpoints from all sides of the fence before we get to Shelter's report. This is an interim report on a research project that's tracking 400 tenants moving into social rent homes and following 134 people, so pretty robust really if controlled for other factors. Within 3 months of moving in, 61% saw a meaningful improvement to their mental health, 36% say that's due to less stress about being homeless or losing their home, and 30% say their health improved thanks to sleeping better. Now look, self-reported, so self-reported conclusions, and you also would need to read the questionnaire or the interview files to ensure that questions have been carefully designed so they're not leading questions. But 45% said they could afford utility bills better thanks to moving into a social home. 51% who were in debt before moving were no longer in debt, which I think is probably a pretty objective number and pretty impressive. And then 62% reported the social home move had a meaningful impact on their ability to plan for the future. 46% reported a sense of belonging to the neighbourhood. So these conclusions are all wholesome, great and positive, but the money truck will just get driven through these, in my view, by the Treasury. We need real measurement, free of self-reporting. How many times did you go to the doctors before, and how about now? Bank balances. Firm, unavoidable data. As much as there's genuine upset when you're talking about a subject like this and it's made all about money, then ultimately the resources will otherwise be allocated elsewhere by people making better business cases for public funds, in my view. So in terms of the economic analysis side, Shelter have had that carried out and suggests not building 90,000 social homes per year, so then presumably they mean by building none rather than 90,000, would cost the government 117 billion in a decade, 64 billion in direct costs and 52 billion in missed economic opportunities. There seems to be a billion in there in the rounding as well, so if anyone wants to send that my way, I'd appreciate it. The cost of debt inevitably used to build social homes, arguably doable by changing the fiscal rules to allow social home provision on a critical infrastructure basis, which probably wouldn't ruffle too many feathers, I don't think. At 5.5% for 30-year money these days is far more problematic than it was a few years ago, sadly. However, I accept Mr. Sunak and his team were rather distracted at the time, even if I reflect on it as that period of time that got away. Remember, Boris's government came in 2019 saying they were going to spend 600 billion on infrastructure over the course of the parliament, and then instead they spent it on COVID, or they spent about 450 plus the interest. Before that virus descended. They could have still done it if they'd issued 50 or 100-year COVID bonds in order to, they had a real war effort kind of mentality. It's a real shame that they didn't try and do that. If only they'd been reading the supplement back then, perhaps they could have put two and two together. But there we are where we are. And I'm afraid my conclusion on this report is that it needs more hard evidence than self-reported changes in personal circumstances. I don't doubt for a minute that all these things reported are true, but how can you actually measure them? And how do you get to the people who make decisions based on what it says in the Treasury Green Book and things like that? So I had a tilt the other week at the Joseph Rowntree Foundation for their report suggesting buy-to-let landlords had inherent advantages over first-time buyers, which I posited was nonsense. Pre-2008, that argument held much more water. Post-2016, it had really evaporated. The easiest way to understand the advantage is that the average first-time buyer is about 25 years younger than the average landlord. So they've had more time, haven't they, the landlords, to save and accumulate funds. And that really is the big one. But anyway, Joseph Rowntree Foundation has released another report this week about living standards in the past decade of falling incomes. This was inspired by the suggestion that average incomes will fall about £550 over this parliament, which is a figure that was thrown around at the budget time last year. And this would therefore be the worst living standards performance of any parliament on record, which is obviously shocking. The kick-off is that household disposable incomes have still not yet recovered to pre-pandemic levels. Now, they make the point that inflation has come down, but that doesn't mean prices actually come down. It's the rate of acceleration that's slowed, which is a point that people often miss. Prices are still going upwards. Wages are stagnating, although they've been up about 1% or so in real terms in the past 12 months, which I don't think is bad in the backdrop of employers' national insurance being hiked, the advent of AI, etc., inflation on the way up and unemployment on the way up as well. They do note that inactivity has fallen, as I regularly do when we look at the labour market report, with fewer people looking after their families or studying. And then the JRF also note their analysis is in contravention with the RHDI stats, the real household disposable income, which I like and rely on a fair bit from the ONS. You can't really appraise their methodology versus those used to understand real household disposable income, because that's expected to move up by nearly 3% over the course of this Parliament. And that would certainly be I don't know what more you can do than wage growth quite fairly significantly outstripping inflation, as it has done for several years since the pandemic. I appreciate there's been localised inflation in terms of mortgage rates going up and all the rest of it, rents going up, although what's actually happened, generally speaking, is that impact has been delayed, so people have had time to prepare for it. But they point out some of their methodological differences. Firstly, they expect housing costs will outstrip inflation. So what do we know today? New rents are up 2.4 from Zoopla. Inflation is expected at 4. Existing rents are still lagging, but they're about 6, but they're coming down fairly rapidly, and we expect them to be at or below inflation probably by sort of Q2 next year, maybe Q3. That's sort of roughly where the trend in the curve is going. And it's inevitably going to be the case because ultimately demand is down and supply of rental units is up compared to recent years, not compared to 2016, 2019, whenever you want to compare it to. Expected household bill inflation is probably between 0 and 8%, let's say 4% for the coming year. I think you probably expect council tax to be up another 4.7, which is the number it was across the country this year. But historically, rents have lagged inflation in recent years. And the never told story that I've told a few times, in fairness, is that rents are a far lower slice of household incomes than they were in 2005 when the ONS first started collecting figures. These facts are never mentioned, and the reasoning behind housing costs going upwards over the last 12 months, when conventional wisdom would suggest 1 or 2 base rate cuts in the interim, likely lowering mortgage payments, especially on those 2-year loans, is not clear to me. JRF just state it as fact. I don't know where it comes from, and I don't believe it, to be honest with you, but there we go. So the sideways market at the minute is delivering 1.5% to 2% capital growth a year, but I can't see much reasoning behind why households will be worse off in a year's time, to be honest. But I don't really want to do a long diatribe, even if I could see JRF's methodology and talk about whether the ONS or the Joseph Rowntree Foundation are better. It just seems unproductive, right? A skeptic might say the JRF don't like the official line, so they've come up with their own, which suits their agenda. And that is, unfortunately, that's what it reads like to me. So when you break it down, they rely massively on increased housing costs for their conclusions. The rest is lower earnings than might be expected, bringing things up less than expected, and then taxation, which will be correct or an underestimate, as we all know that the tax thresholds are going to be frozen again at the coming budget for 2 more years, right? There's one piece of analysis hidden in the data which speaks as to why the triple lock on pensions needs to go, however. JRF sees average income from social security increasing by £120 per household by the end of the Parliament, assumed in 2029. Now, it's interesting, this breaks back as an extra £270 for pension age households, minus £150 to middle age households, and minus £240 to younger age households. And this ultimately is their purpose as a foundation, the Joseph Rowntree Foundation, lower income households. And so they always take it hardest in tougher times. And they've got bigger expenditures, of course, because they've quite often got children and things like that. So even with these miserable assumptions that the JRF make, the pensioner couples are better off, right? The hardest hit, single parents, then couples, right? Couples with children. So onto their proposed solutions then. Remove the 2-child benefit cap, which is now, warmly being talked about as happening in the budget. Reverse the health-related benefit cuts to universal credit. I'll just say something on the benefit cap, by the way. I find it strange if they do that at the budget. Fiscally, they could and should to an extent. But if they're not using that as leverage to get the welfare cuts through they know are needed, and they couldn't get the support of the wider party for, they're more stupid than anyone's giving them credit for, to be honest with you, because that's their best bit of leverage. It's then repurposing of some of those benefits to stop child poverty, which almost anybody would really struggle to make an argument against. But if they give first and then they come back for the welfare cuts and they don't get them again, it's just an economic disaster for the bond markets and for their credibility as a government, which I accept is not that high at the moment, for good reason, realistically. So what do they also want? They want reverse health-related benefit cuts to universal credit, permanently unfreeze LHA, as usual. This is where the The left and the right typically agree for different reasons, but ultimately, if you want the market to work, you have to have a functioning LHA rate. We just don't have one at the moment. Increase targeted support on energy bills and reform the household support fund. They stop a bit short of universal basic income, but they're basically heading on that path. An essentials guarantee in universal credit. Be interesting to know what those essentials are. Well, how do we pay for that? Well, raise taxes, of course. CGT rates in line with income tax. An incorrectly banged drum all the time, ridiculous, and everybody knows. We've seen all the projections. CGT take will then go down. So this is just a silly suggestion. Equalise income tax on investment to PAYE. They say whack NI on investment income, whereas I think the fairest way is just get rid of employees' NI and equalise the income tax rates. But the fairness case for that, I've said before, I actually agree with the fairness case of that. It's what should happen, and it would make a big difference. But they also advocate whacking an exit tax on those leaving the UK. So a bit of skullduggery there, but it would make money, of course, so bear in mind. But if we have to imprison our entrepreneurs and our wealthy, what does that say about the state of our nation? You know, can't control the borders, but have to keep people in chains or charge them for leaving. It's not the best look for the United Kingdom, is it? But anyway, I'm scratching my head and struggling to debunk the ONS figures over and above the JRF figures. I just think this just suits their agenda far too much. It doesn't do anything to quell my fears on that front. The ONS is not perfect. I say it all the time. But if you're suggesting they're 4% out on disposable incomes over the course of this parliament, I think you've got to do a lot more than sort of some fairly concealed methodology. Okay, let us move on to the history section. A little piece to commemorate the 3-year anniversary of that budget, the budget that blew up the bond markets and potentially did us at least a couple of favours, although they will fall under the law of unintended consequences. So I've seen Liz around on podcasts and the likes, giving her own recollection of the event, and as the royal family would say, recollections may vary. And of course, she's defending her own honour and trying to promote her book. It sold 2,228 copies in its first week some time back. You compare that to David Cameron's memoir, he sold 21,000 copies in week 1. Boris did about 42,000. So it's about 5% as good as Boris, which is not the best yardstick in the world, is it, realistically? But it might be proportional to their term in office. Not quite, because Cameron was PM for longer than Johnson, but there we go. But the broad claim that she makes, that she was stitched up by the Blob and the Bank of England specifically, is how she justifies what happened. And it's just a straightforward misrepresentation of the facts, especially the last bit. The Bank of England announced active gilt sales, which I've said before, terrible idea, but they did. Liz and I would probably agree on that front, I'd imagine, but probably for different reasons. They announced it on the 4th of August 2022. Liz wasn't PM until the 6th of September, and on the 7th of September, in unrelated to the fact that Liz had just become PM, the bank confirmed they would begin active gilt sales on the 3rd of October. This really should not have affected any budget. If the guardrails, remember, she doesn't believe in guardrails, put in place had been followed, there would have been a period where the OBR were asked to update their forecast and a new budget would have taken place in late November or even early December. Not Liz's plan, though. Instead, 2.5 weeks later, a mini budget, the Growth Plan 2022, was delivered, attempting to get around the guardrails by saying it wasn't a budget, basically. There wasn't much mini about it, though. 45 billion in unfunded tax cuts, a UK record as it goes. The markets got spooked. It was a Friday. Presumably that was deliberate so the fuss could die down over the weekend, or whatever Liz and her team of advisors were expecting to happen. But that didn't play out, because on Monday, the 26th of September, the gilt yields went through the roof and sterling fell to embarrassingly low levels as people speculated that the $1, £1 floor might be breached and the dollar be worth more than £1. We were back to sort of the early 80s when there was a bit of an economic mess around exchange rates and interest rates and the likes, and it was ridiculous. So in the background, there were pension schemes that had used leverage and they got margin calls. The worse the yields got, the more they needed to sell bonds to pay these calls. So that put the bond prices down even more and put the yields up even more. The absolute dictionary definition of a vicious circle. And it took a couple of days for Bailey and the mob to get together, right? But when they did, they announced they would buy gilts. Great time to buy gilts, to be honest, when prices are low and yields are high, and would postpone the active gilt sales. So it's almost the direct opposite of what Liz claims, this stitch up. It was the rescuing a team that were hopelessly clueless about bond markets and macroeconomic policy. So now, broader context, this was a mess, and make no mistake. However, a bit like that fantastically British sport of cricket, there was a night watchman style batsman waiting in the wings. The recent bridesmaid of the leadership contest, Rishi Sunak, he was the one who could calm the markets down, and when Liz was finally got rid of on the 20th of October 2022, he took the reins. But don't forget, Kwasi was booted on the 14th, 6 days before, although that was Liz's last straw, and it was Jeremy Hunt, the night watchman Chancellor, that took over and made an emergency statement on the 17th of October. Pretty simple, basically reversed everything that Truss had done, apart from a couple of little nuances. The sacking of Kwarteng felt like the sacking of a bad CEO or a bad football manager. The markets immediately looked more positive, or the fans responded resoundingly positively on social media. Most of what Hunt did was just not rocket science at all, which is why he was able to do it so quickly a couple of days after appointment. And often you hear wannabe Liz defenders, or perhaps those who are just inherently opposed to a Labour government, and don't get me wrong, at this point in time, who could blame them, say that bond yields are higher today than in the time of Liz Truss. True, but I'm not sure if they're being deliberately obtuse or if they just don't understand context. I've said many times before, a lot depends on what happens, but it's also where you are in a cycle at the time. I've often used the example of the Brexit referendum created inflation, the currency dropped by 20%. We import a lot of stuff, that made things more expensive. Right, inflation touched about 4% at that time briefly in sort of late 2016, literally solely based on massive currency fluctuations post-referendum. Right, why was it only 4%, and why did it calm down relatively quickly? Well, the exchange rate started to repair itself because there was a bit of market panic, which then became more realistic over time. So that was one thing, but also we came from a place where inflation was stable. It was under control. It was around the 2% target. So we could absorb a shock, whereas ultimately we're absolutely not in a position to absorb a shock in September, October 2022. So if we look through the lens of the 5-year gilt yield, which is what kept me up at night at the time, this decayed from over 5% in 2008 to 2.5% in 2009. And then the rest of the decade, it just trended beautifully and slowly downwards as money got really cheap for borrowers, right? Then in 2020, it went just a little bit negative. Yet you actually lost money buying 5-year gilts, but deflation was a concern at one point, and that explains why gilts still traded at that level. And then by the 1st of August 2022, we were back to 2.4 on the 5-year. And that had been a fairly steep climb before the letters had got into town. But in a short, very, very short time frame, we absolutely short-circuited to 4.4 on the week that started after the mini budget, that fateful 26th of September. A move of unbelievable magnitude for a bond market. You know, these are medium-term debt instruments that are not supposed to be volatile. And we stayed around that 4.4 level until Kwasi was gone. There was a direct correlation, and then a plunge that actually went to an unjustifiably low level. We dipped back to 2.9 in late January 2023, which was pretty much where we would have been if we carried on that pathway that took us to 2.4 before Liz got there, right? Such was the market's confidence that Sunak had all of this under control, in spite of the fact that at the time, you might remember, inflation was in a double-digit hole. Now, that was never right, but it's symptomatic of how markets work and how trends work. The vigilantes came back as inflation looked stickier than the transitory players had predicted. I still don't really believe they believed all that. They just said it because they had to, in my opinion. They knew what was going to happen. Andy Haldane certainly knew what was going to happen, and he made no bones about saying it, the chief economist of the Bank of England at the time. I'm happy to say we hit this new higher high of the 5-year at 4.98% in early July 2023. So I'm delighted to say we haven't been back up to 4.98. And in fact, we had a Christmas present in late 2023 as yields went back to 3.25 briefly. But service was resumed at that sort of 4% level. And that's the range. Ever since I've been talking about a range for the 5-year gilt, it's been sort of 3.75 to 4.25. And we haven't been much outside of that range. We've had a little couple of wobbles, especially when there's been concerns over spending, Rachel Reeves, things like that. But ultimately, we traded in that range for some time. So 5-year gilt has been particularly stable. 5-year swap, it changed from trending above 5-year gilt rate to trending below, and this sort of 35 basis point discount that I talk about on a weekly basis is about roughly where we've been for the last year or so. So the 5 year, why focus on the 5 year? Because it's the 10 year that does the majority of the lending to the UK in terms of government bonds that trade, because the pension funds and the institutions like a 10-year horizon. Well, suits my business, of course, but it also defines the majority of UK mortgage debt. As I said earlier, it underpins the housing market when, certainly for first-time buyers anyway. Swap rates are heavily influenced by it and have traded in a much tighter range than the gilts have in the last 18 months as well. Rates have just not changed very much over a little bit over 18 months, in spite of 5 base rate cuts, in that time frame. But it hasn't really moved much of the needle on the 5 year, particularly. We were already down at that sort of 4% level. Or indeed, if we went back to Christmas 2023, we were at 3.25%, which were about 3.5% on the swaps, there or thereabouts. So let's just explore one more point of order before we consign the letters to the history books one more time, until I bring her up next week, of course, which I reserve the right to do. What about the defence of right ideas, wrong timing? So, a bit more context. Truss often loves the comparison, or desperately courted a comparison to Thatcher. Now, what did Liz do? 45 billion of unfunded tax cuts. What evidence did she actually present that it would actually increase the tax take over time? None. It was just ideology. I'm not suggesting that it's wrong, but she didn't have any evidence, didn't have the backing of the OBR. Growth, sure, but who would be the beneficiary of that growth? The point isn't even really if she was right. Indeed, under the current tax regime, you'd suggest that some cuts would be extremely helpful for growth, as the private sector has actively been battered by the Reeves budget of 2024. However, the game when you owe trillions to international investors is that you have to justify what you say, not just guess. That's where the OBR actually helps and is their raison d'etre to an extent. Andy Burnham was criticised for saying, forget about the bond markets. It's not really what he said, actually. What he said was we need to get ourselves out of the situation where we rely on the bond markets. But it's a silly thing to say, because it takes generations to lower the debt from where we are today to something much more meaningful at, say, 30%, or somewhere where a Norway or whatever of the world is. When we're at 97% gross, 83% net, that's where we are ultimately in terms of debt to GDP at the moment. Andy Burnham's not going to sort that out, because he'd be long retired by the time it would take to get us to where we need to be. Anyway, the OBR actually helps, right? It's their raison d'etre. They can forecast things. They can say whether those cuts would have actually worked and would have increased the tax take over time and would have increased the GDP. What did Thatcher actually do? Well, she was in a different place from Liz, because there was genuine stagflation, double-digit inflation, same thing. Weak growth, well, we were on the back of quite strong growth, but that was bounce back growth, or the V-shaped recovery, or whatever you want to call it, after the pandemic. But high unemployment. Now, we were not at high unemployment, we were at low unemployment, under 4% at the time. Inflation control wasn't the overarching strategy back in Thatcher's day, and it became so, and overall it's been a pretty macro success around the world since then. In 1979, the budget cut the top rate of income tax from 83%, yes, 83 to 60. Basic rate went from 33 to 30. But this was funded. VAT went from 8% to 15% to compensate. The top rate was down to 40% by 1988. Why did it work, and why did it keep people happy? Because people look at what happens comparatively, not at absolutes. It was lower than before. 60% was a good start. If you put the top rate of tax up to 55% today, that would be viewed as horrific, certainly by the aspirational and the higher earners, of course, because it's currently 45%. The mini budget was much less ambitious in a way. 45 went down to 40 in terms of the additional rate. Basic rate went from 20 to 19. National insurance was not going to go up, because at the time it was supposed to go up, employees' national insurance. And the planned corporation tax increase was scrapped. That was going from 19% to 25%, with a transition period in the middle for profits between 50k and 300k, which is the current system that we have. She tried to scrap that, right? How was that funded? Well, it wasn't funded at all, just to be clear. It was just all going to be debt funded, right? Thatcher had a clear monetarist plan and medium-term financial strategy. There were full Treasury Red Book tables and spending plans. Fiscal credibility was restored by controlling the money supply and this medium-term planning. And of course, this was on the back of a decade of massive inflation, and probably at the the ascendancy of the Hayekian school, Milton Friedman, if you haven't heard of him, very much worth looking at some of his stuff on YouTube. Truss had no forecast published when she made this sudden announcement. No medium-term fiscal anchors, no spending cuts, no respect for convention, guardrails, and effectively the investors who funded UK debt. So, right idea, could have worked. Well, maybe, but the methodology was just doomed to failure from day one. And frankly, a 16-year-old advisor could have seen that coming. I still have no idea what they were thinking, or indeed if they were even thinking at all. There's no timing in just ignoring the rules, right? How about the favours that were done, though, unintentionally, just to finish us off for the week? Well, the shock to rates pricked any bubble in the housing market, which had been created by even cheaper rates, and a lack of supply of homes in the open market post-COVID. You could argue that still today, we're seeing more homes for sale because of the pandemic, slowing people's plans down by years and years. And it's property, these assets, especially for people in the retail side of things, which is like 90% of the transactions that are happening at the moment. Only 10% are being bought for investment, roughly, on the most recent figures I've seen for Rightmove and Zoopla. And if you think 30% are disposing in London, you do the maths, but they still say the supply is going up at the moment. I think it'll be going down pretty soon myself, don't you, on the back of all of that. But yeah, it slowed people's plans down by years and years, the pandemic did. And then that shock after the mini budget caused mass fall throughs in the market and was directly responsible for an immediate adjustment in pricing in 2023 by a few percent, as inflation absolutely battered the real value of housing, and it probably went down more like 15% on that year, or over the course of 18 months in real terms. Something did need to take the heat out of that market, though, and it wasn't anywhere near as painful as previous crashes by any stretch, mostly thanks to the way that inflation impacted everything. What's the other big one that becomes more clear and perhaps more pertinent? There's about a 50-50 chance of a reformed government next time out, according to the markets at the moment. How not to do it. We were at the time the laughingstock of the world. It was such a naive, clueless move, even if you wanted to argue that Liz had good intentions or the right ideas or whatever. That will last in the memory until the next election, and hopefully will inform reform, if they do get in, about how to treat the checks and balances in place. He says, crossing his fingers, right? If they come in and immediately set fire to the OBR, which is perfectly possible, without replacing the mechanism somehow and just seeking government by executive order, a la Trump, which is obviously one possibility, then the markets will wobble immediately. But this time there's no 1922 committee, and there's no replacement for Farage at the moment. There's an awful lot of water to go under the bridge until the next election, which still looks like it'll be 2029 to me. But that's food for thought for the week anyway. And please, just remember, keep calm, always listen to the supplement and carry on. There's opportunities abound this year towards 2030, and beyond that, the landscape is set for a surefire bull run. It'll be slowish, it'll take a little while longer to get off the ground, and the amount of stock around is still keeping things suppressed at the moment. But as rates can currently continue to improve ever so slowly, it's a case of here we go, in my opinion. Thanks, folks.